Okay, bond yields in Canada affect mortgage rates. There's no secret to this. Since I started brokering mortgages 20 years ago, it was always understood that mortgage rates should be 1.5% higher than what the yield on the Government of Canada bond is. The Government of Canada, through their bonds, sets the price for risk-free money in our country. The yield on a Government of Canada bond is essentially the risk-free yield that investors will accept in the marketplace. Today, November 21st, the Government of Canada bond yield is about 3.7%. Lucky for us, we did a show on July 19th where we discussed what the best option for a mortgage was. And guess what? The Government of Canada bond yield on July 19th, when we did that show, was about 3.7%. So in November of 2016, the Liberal government ended portfolio insurance. When the portfolio insurance product was taken off of the market from CMHC, that is when we've created a market for two different types of interest rates in Canada. That's how we have now insured rates and uninsured rates. An uninsured mortgage rate is a mortgage rate for a Canadian consumer that has greater than 20% equity in their home and whose home is worth more than $1 million. Those customers can no longer go to a mortgage finance company and get portfolio insurance on their mortgage. That portfolio insurance product was driving down mortgage rates in Canada by allowing mortgage finance companies to compete with the Canadian banks. They can't do it anymore. So what happened? The Canadian banks watched as these mortgage finance companies slowly found their bearing in this market, in this new market where they would have to borrow money to lend out onto these mortgages without the guarantee of the Government of Canada. So the Government of Canada revoked portfolio insurance under the auspices that it was too risky for Canadian taxpayers. But if you really dive into it, the mortgages that we're talking about are the lowest risk mortgages to the wealthiest borrowers. See, before November of 2016, if you were a mortgage finance company and you wanted to do a mortgage for somebody that had a $3 million house and wanted a $1.5 million mortgage, you would just go to CMHC, you'd pay 20 or 30 basis points, you'd slap the insurance premium onto that mortgage, you'd underwrite the mortgage, you'd lend the money, you'd put it into a big basket of other mortgages that also had that portfolio insurance, and you'd sell them out into the open market, and they would get bought up by pension funds and mutual funds and institutional investors of all kinds at the risk-free rate. And that meant insured, uninsured, whatever kind of mortgage it was, as long as it was insured by CMHC and therefore the Canadian government, all of it was trading at about 1.5% above what the Government of Canada bond yields were. Fast forward to today. We've removed portfolio insurance. So the banks let the mortgage finance companies figure out how expensive it was going to be for them to compete with the banks in that uninsured space, which typically now for a mortgage finance company, ironically enough, involves them getting a line of credit from a bank in order to fund those mortgages, bundle them up, and then sell them as uninsured mortgages into the open market. The premium that they've added on to those uninsured mortgages, the banks sat back, watched, and then added that premium to their own mortgages because that's what the market was. They waited for the mortgage finance companies to identify what the market would be and then let their pricing be known in the market to match the mortgage finance companies so as not to capture necessarily much more market share, but to capture more net interest margin, more profit on the loans that are less risky. What I want us to look at with this chart, you can see we've put up what the bond yields were today and what they were on July 19th. And the easiest apples to apples comparison we can do to start off with is the 5-year fixed. Let's look at the 5-year fixed. So bond yields today are the same as they were July 19th. In the last 4 months, Government of Canada bond yields have gone up. They have gone down. Well, more up than down, but they've come back down and now they're at 373 again. At the time that we did this 4 months ago, the 5-year fixed rate was 6.14 on the uninsured and it was 5.49 on the insured. We saw the uninsured rate come down by 5 basis points and we saw the insured rate come down by 20 basis points. I think that what we are seeing across the board, across all of these rates, is that the insured product is behaving more normally. And the uninsured product is where the banks are looking to kind of get the profit that they can because they know that there isn't competition from anyone other than the oligopoly of the 5 banks. So there's no mortgage finance company playing in that market. They can gobble up a little bit more profit. You can see that we saw a 20 basis point drop, even though the Government of Canada bond yield is the same. And that speaks to overall an understanding now that we know where the market is going. And a little bit of that premium, that risk premium in that typical 1.5% spread off the Government of Canada bond yield is coming off. That's a good thing overall. Means the market's coming to a greater understanding of what's going to happen with interest rates going forward. Okay, now let's look at the early part of the yield curve, the 1 year and the 3 years. So also interesting stuff going on here. At the time that we did that show in July, we were recommending either a 1 year or a 3 year, kind of depending on what your risk propensity was. And you can see that 3 year back then, look at all the juice that was in that product. The 3 year Government of Canada bond yield was at 3.14%, and the insured product was at 6%. That's almost 3 percentage points of margin in that thing. You gotta understand, the market buys insured mortgages and they consider it to be of the same risk caliber as the Government of Canada bond yield on that day. Banks were lending out money at 6% on the insured 3-year product, and it was costing them 3%. On the uninsured side, they were charging 6.44%. So that spread, again, that roughly 50 basis points in this case, that's attributed to the removal of the portfolio insurance product that prevents banks from having serious competition in the uninsured mortgage space, thereby allowing them to increase their profit margins on that side of the market. Fast forward that to today, where the bond yield has gone up to 4.27%. So we're like over 1 percentage point higher. And we saw the insured pricing on the 3-year come down by 10 basis points. So again, coming to a more normalized spread off of the 3-year yield. So the spread's tightening on that 3-year. And I think what we're seeing happening here is it's almost like the bank is saying, like, you got to imagine the Canadian bank, because it's like, imagine it's one bank, right? Oligopoly is very clever. You've walked into the bank's store and you're now armed with more information than you usually would be. You're getting a heck of a lot more information about what's going on with inflation, what's going on with mortgage rates, what's going on with housing affordability. And you have some general understanding that, hey, interest rates are really high right now. They're going to come down, but you still are uncertain. You're a little bit gun shy. You have to understand, like, that's probably most of the Canadian consumer. So maybe when they went into the store to get a mortgage in July, that Canadian consumer, there was a little higher a probability that they were going for that fixed rate product and they were going to go to that 3-year product. Banks understood that. They jacked up the profit margins on that product. Now, if you're going into the store to get the same mortgage, you're kind of going in thinking variable rate mortgage is probably the way I want to do this because I know that the Bank of Canada is going to start dropping interest rates. I don't really want a 5-year and I don't really want a 3-year, but the banks, in an attempt to try to keep you in a fixed product and book those margins, those net interest margins that they so dearly, dearly need in order to boost their profits because they don't make enough money as it is. They've now reduced that margin from the gross amount that they were making in the past to still try to entice you into a 3-year. What does that tell you? Stay away from the 3-year. So then you're thinking to yourself, okay, why don't I take a 1-year? Because you're smart. You're thinking to yourself, okay, rates are going to come down. I know I probably have a year to weather this thing. Why don't I take a 1-year fixed? What does that look like? The 1-year fixed, whereas before in July, when the bond yield was at 5.19%, the insured product was at 6.5%. So you're looking at like a 140 basis point spread. Today, we've seen the yield drop, but the rate on the insured has not dropped by as much. So they know you're still looking at that 1-year. They're going to take a little more off that 1-year. They're going to make a little more off that spread on that 1-year. It's even further highlighted in the uninsured rate. Let's go back to the yield, okay? July 19th, the yield was 5.19%. The uninsured 1-year mortgage product was 679. Spread 1.6%. Today, big change, yield 4.93%, 1-year fixed rate product 7.09%. Again, it's a factor of more demand flooding into that 1-year, more well-informed Canadian consumers going into that 1 year, and the bank saying, well, if we see the demand for that 1 year, let's jack up our margins on it, because it does make the most sense for the Canadian consumer. Let's go to the totally most obvious spot where we can see it, the variable rate. Okay, the variable rate mortgage is the easiest one to judge. 7.2% prime rate then, 7.2% prime rate now. Variable rate insured mortgage July when we did this show, 5.95%. Variable rate insured mortgage today, 6%. Nothing has changed. They've added 5 basis points. 5 basis points is a lot of profit. Let's leave that for a second though. Let's go where the big boys play, where the banks really like to squeeze the consumer and make their margins. Let's go to where they have no competition, because November of 2016, they removed the portfolio insurance. Uninsured mortgages, where they don't have the competition, went from 6.4%. Now we're at 6.75%. 35 basis points of unanswered profit off the variable rate mortgage discount. Now, imagine, right? This is what this means. If you want a variable rate mortgage now, you're going to lock into a variable rate mortgage that's 35 basis points higher than what it was 4 months ago. And guess what? It's going to be 35 basis points higher for the next 5 years or 3 years, whatever the term you get your variable rate mortgage for. And you're going to have to deal with that unless you break it. Another fun note here, 75% of all Canadian mortgages break before maturity. You may not have known that, but you know who did know that? The bank. All of these numbers that I'm spewing out at you here highlight that you should probably speak to a mortgage broker, an independent mortgage broker, to help you through this process. Because what the bank is doing is they are identifying where the demand is coming from, and they are increasing their net margins on the products that are most demanded by the Canadian consumer. All that's going to do to our economy is going to increase the profits for the Canadian banks, and it's going to decrease the Canadian consumer's ability to get the monetary stimulus that the central bank is going to push out into the economy. It's a really cat and mouse behavior here happening, right? If you're a Canadian consumer and you want to navigate how to get the most out of what the Bank of Canada is about to do to re-stimulate our economy, the last place you should go for unbiased information is your bank, because they're very clearly ratcheting up profit wherever they see demand coming up. Now, as we look at this right now, you have to make a decision between a 1 year fixed and a 5 year variable. What direction are you going to go? It depends on a whole bunch of factors. How long are you going to hold your mortgage for? What do you plan on doing in 12 months? Are you going to sell your house? All sorts of questions. But when you walk into your bank, they don't care. They want to maximize the amount of profit they make on your mortgage. Don't be fooled. Understand that they are not motivated by the same thing that motivates you. They are motivated by the exact opposite thing that motivates you. The removal of portfolio insurance has totally screwed you as a Canadian consumer. If you have a house that's more than $1 million, so guess what? Like the average price of a detached home, the average price of any home in Canada is probably over $1 million, even with the most recent drop in housing prices. And if you have more than 20% equity in your home, which most of Canadians do, take a good look at this chart. And if you have questions, put them in the comments bar and we'll do another show about it. Thank you very much for your time.